Making personal deductible contributions to your super is a really good way to save some tax. But the problem is, you're limited to how much you can put in each financial year. However, there is a way to double your contributions in a single financial year to make your tax deduction that much larger. And this is referred to as the double contribution strategy, or also known as the contribution reserving strategy. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. And today we're talking about the double contribution strategy for self-managed super funds. The current cap limit on concessional contributions in this financial year, that's the 2021-22 financial year, is currently $27,500. Now, it's important to remember that any employer superannuation guaranteed contributions, any salary sacrifice, and of course, any contribution that you put in yourself and intend to claim a tax deduction for, that's going to form part of the cap limit. To implement the double contribution strategy, which is essentially going to allow you to contribute up to $55,000 in a single financial year, there's really two things that you need to be aware of and you need to do. You need to time your contribution appropriately, and you need to have the contribution allocated in the right financial year. So with regards to timing, and for this example, I'm going to assume that you want to use the full $55,000 under the double contribution strategy. The first $27,500 needs to be contributed into your super fund prior to the month of June. And that contribution is going to get allocated in the current financial year. The second contribution, which can also be up to $27,500, needs to be contributed in the month of June. So you have a 1 month window to make that contribution. And this contribution, the trustee is going to sit it in what's called the reserve account in your self-managed super fund. And the trustee has 28 days from the end of the month in which the contribution was made in order to allocate those funds to a member balance. So by reserving the funds before allocating it to a member's balance, it means that the trustees can essentially push that contribution into the next financial year and have it counted towards the next financial year's concessional contributions cap. Now, this whole strategy works because a member's contribution isn't going to count towards their cap limit until it's allocated towards their account. But on the other hand, a tax deduction is going to apply when the contribution was made. This strategy is going to be particularly beneficial if you know that you're going to have a lot of assessable income in a single financial year. So really an outlier kind of year. And maybe it's because you sold an investment property and you made a big capital gain on it and you're looking for a way to offset some of that capital gain. Well, the double contribution strategy can be pretty handy in that scenario. Obviously, there are a number of considerations that you need to take into account before implementing this strategy, so let's go over a few of those now. The double contribution strategy is only available to self-managed super funds. Public offer funds, so think retail funds and industry super funds, won't allow you to implement this strategy. Your self-managed super fund trustee must meet and agree to this strategy, putting together a trustee resolution. Your SMSF trustee must also allow for reserves. As already discussed, the timing of your contributions and the allocation into members' accounts is crucial to this strategy. If you use this strategy, you will limit the amount you can contribute in the next financial year as a concessional contribution. You're essentially bringing forward the use of next year's cap limit, and therefore you need to be aware that this may lead to breaching the concessional contributions cap limit in the following year, particularly if you are getting employer contributions. This may lead to excess contribution penalties. And of course, you need to meet the eligibility requirements in order to make personal deductible contributions to your super. So there's a lot to consider there, and this can be a fairly tricky strategy to implement. So if you are thinking about doing this one, it's one where I would suggest that you get some professional advice. So go see a financial advisor. They can help you determine if it's appropriate, and if it is appropriate, help you do it correctly. But that's it for me today, guys. Thanks a lot for watching. If you like this video and if you're thinking about doing the double contribution strategy, please give it a thumbs up and I will see you guys in the next one.